Every single day, millions of people wake up, go to work, earn money, and then let that money just sit in a bank account, earning almost nothing. Meanwhile, the wealthy, the top 1%, are quietly putting their money to work. And the secret? They understand the difference between these four investment vehicles: index funds, mutual funds, ETFs, and hedge funds. By the end of this video, you will understand all four, not just on the surface level, but deeply enough to make a smarter, more confident investment decision. So if you're serious about building wealth, hit that subscribe button and let's get into it. Before we break down each fund type, let me ask you a very important question. Do you actually know where your money is going? Most people don't. They hear the word invest and they panic. They think it's too complicated, too risky, or only for rich people. But here's the reality. Investing is not optional if you want to beat inflation. The value of your money sitting in a savings account is silently being eroded every single year. And the four investment vehicles we're talking about today, they are the foundation of modern wealth building. From everyday middle-class families to billion-dollar institutions, they all use some version of these tools. So let's break them down, one by one, starting with the most beginner-friendly option on the planet. Imagine you walk into a restaurant. Instead of ordering one dish and hoping it's good, you order the combo platter, a little bit of everything on the menu. That's essentially what an index fund is. An index fund is a type of investment that tracks a specific market index, like the S&P 500, which is a list of the 500 largest companies in the United States. Companies like Apple, Microsoft, Amazon, and Tesla. When you invest in an S&P 500 index fund, you're not picking one stock. You're buying a tiny slice of all 500 companies at once, automatically, passively. Why does this matter? Because historically, the S&P 500 has delivered an average annual return of approximately 10% over the long term. You're not trying to beat the market, you're becoming the market. And the fees, incredibly low. The average index mutual fund charged an expense ratio of just 0.05% in 2024. That means for every $10,000 you invest, you're paying roughly $5 per year in fees. Who is this for? Index funds are perfect for long-term passive investors, people who want to build wealth steadily over decades without constantly watching the market. Warren Buffett, arguably the greatest investor in history, famously bet a group of hedge fund managers that a simple, low-cost S&P 500 index fund would outperform their complex, actively managed strategies over 10 years. He won by a wide margin. That tells you everything you need to know about the power of index investing. Now, mutual funds might sound similar, and in some ways they are, but there's one critical difference. A mutual fund is a professionally managed investment pool. You and thousands of other investors put your money together, and a trained fund manager decides where to invest it. They analyze stocks, bonds, and securities, and actively buy and sell to try to generate better than average returns. Think of it like hiring a personal chef instead of using a recipe book. You're paying for their expertise. The upside? You get professional management and research working for you. Access to a diversified portfolio without having to make individual decisions. They're available through most retirement accounts, like 401ks and IRAs. The downside? This expertise comes at a cost. The average actively managed equity mutual fund charges an expense ratio of 0.64% per year. That's nearly 13 times more expensive than an index fund. And here's the kicker. Research consistently shows that the majority of actively managed mutual funds fail to outperform simple index funds over the long run. You're often paying more for less. There's also a tax consideration. In 2025, around 52% of mutual funds distributed capital gains to investors, meaning you could owe taxes even on a year you didn't sell a single share. Who is this for? Mutual funds work well for investors who want professional management, especially within retirement accounts, or for those who prefer a more hands-off approach but want active guidance in volatile markets. Number 3, ETFs, exchange-traded funds. Okay, this is where things get really interesting, and frankly, ETFs are becoming the favorite tool of a new generation of investors. Here's the simplest way to understand it. An ETF is basically a hybrid between an index fund and a stock. Like an index fund, it holds a basket of securities, stocks, bonds, commodities. But unlike a mutual fund or index fund, An ETF trades on a stock exchange throughout the day, just like a regular stock. You can buy it at 9:30 a.m. and sell it at 2:45 p.m. if you choose. This gives you incredible flexibility and real-time control over your investments. The numbers are impressive. ETFs typically have even lower expense ratios than mutual funds. In 2025, ETFs accounted for just 1% of the fund industry's capital gains distributions, despite holding 30% of all U.S. managed fund assets. That's exceptional tax efficiency. ETF holdings are disclosed daily, giving you full transparency on where your money is going. The nuance? Because ETFs trade like stocks, you can get caught in the trap of overtrading, making emotional, impulsive decisions based on short-term market movements. That bid-ask spread, the tiny gap between buy and sell prices, can also add up if you're trading frequently. Who is this for? ETFs are ideal for cost-conscious, tax-aware investors who want flexibility and transparency. They're particularly powerful in taxable brokerage accounts, where their tax efficiency gives them a clear advantage over mutual funds. And finally, number 4, hedge funds. This is the one you've heard about in movies. The Wall Street traders, the billionaire investors, the mysterious strategies that can make or lose fortunes overnight. A hedge fund is a private, exclusive investment partnership that uses a wide range of aggressive strategies, including leverage, derivatives, short selling, and alternative assets, to generate returns regardless of whether the market is going up or down. Here's the catch. Hedge funds are not for the average investor. To even get access, you typically need to be an accredited investor, which means a net worth of over $1 million or an annual income exceeding $200,000. And the minimum investment can easily be in the millions. The fees? Brutal. Hedge funds commonly charge what's known as the 2 and 20 model, a 2% annual management fee plus 20% of any profits they generate. Do they perform? The data is fascinating. The average hedge fund returned approximately 11.5% in 2025, but the S&P 500 still beat them by nearly 4 full percentage points. In fact, research shows that ordinary index funds outperformed the average hedge fund in most years, with hedge funds only beating the market during major downturns. However, and this is important, the top quartile of hedge fund managers are genuinely exceptional. In 2025, the best equity long/short managers delivered 22.6% returns, beating the S&P 500 outright while running hedged portfolios. And what hedge funds do offer that index funds can't is downside protection and low correlation to market volatility. For institutional investors and ultra-high net worth individuals managing huge portfolios,